What's up, y'all? So, welcome to another meeting of how's it called? My exclusive club. Okay, so a lot of people joined, good amount. What's up, boys? What's up, Travis? What's up, Diane? What's up, Adrian? Thank you for joining. Today we are speaking about the second part of basically fundamental analysis, second things that you need to look at whenever you're doing fundamental analysis. Last week, we talked about the first and primary things that we need to look at while doing fundamental analysis. And basically those things like revenues, like net income, EPS, all this kind of stuff. The video is recorded and is on my YouTube channel, not the one which is main channel, not the one which is like Investors Artem, but the one which is Miami Exclusive Club webinars. I decided to separate my two channels so that like it's professionally edited videos and like these pre-recorded unedited webinars, so it's very different style basically. So the channels are split, but basically in my Investors Artem channel, there is a link to my Miami Invest Club, Miami Exclusive Club webinars link channel. And on my Miami Exclusive Club webinars channel, there is a link to Investors Artem channel. So at least find one of them and you will find another one basically. And okay, so since experience of our last 2, 3, 4, 5 meetings already showed that every single time we're barely having enough time to discuss the topics. So I would say that we should begin already. Opening the presentation right now, making it full screen and where is the full? Okay, I'm already spotlighting myself. Photos, share, full screen. Okay, so today's topic is, like I said, fundamental analysis, part 2, next things to look at. These things are a little bit maybe less important than the ones which I mentioned last week. Once again, such as revenues, net income, EPS, all this kind of stuff. But those things are also still pretty useful to take into consideration while analyzing company from fundamental perspective. And this part of fundamental analysis, it is qualitative part of fundamental analysis. Once again, fundamental analysis can be qualitative or quantitative. Qualitative means that you look at like those things basically, management, share repurchases, like whatever is going on with the company, whatever company is doing in its press release, every news that the company is sharing, all these kind of things. But quantitative part of fundamental analysis, this is when you analyze numbers. And usually these are financial statements, which are like balance sheet, income statement, and cash flow statement. Today, we are focusing on qualitative part of fundamental analysis. And today we are finishing qualitative part of fundamental analysis. So basically that's the topic for today. And since today there are some new people joined us, the way I do my, I don't know how it's called, webinars or whatever it's called, okay. So I do a topic, I do one slide. And after this, I basically, right now I have full screen of this, like my presentation is on full screen. So if there is anyone asking questions in the chat, or if there are any people joining, I cannot see this, unfortunately, people. Like a bad thing that Zoom doesn't help you like this, but it is what it is. So if you have any questions while I'm talking, ask them in the chat. And as soon as I switch from one slide to another, I will read all the questions I have and I will answer them. So don't worry, every single question will be answered. I will just, like I said, not be able to see them while I'm talking, but I will see them later. Okay. And today, these are the topics to discuss. You already seen them in the Instagram group, but still, obviously, for YouTube video, it's important to mention them again. So those are the another parts of qualitative part of fundamental analysis that you need to take into consideration while you're analyzing a company. First of all, it's size of the company, then it's plans of a company, its condition, management of a company, insider trading, mergers and acquisitions, and finally customers and some other like minor factors basically. And obviously in the end, if we have time, once again, I always say it and I never have, if we have time in the end, there will be some questions and answers and I'll answer as many of them as I can while as long as time permits. Okay, so this is the first slide and now see if there are any people joined. I don't see anyone joining and if there are any questions and I don't think I see any questions. So that's it, let's go. First thing that you need to look at, well, it's not first, but like it's first thing of the presentation that you need to look at while analyzing a company from its qualitative perspective is the size of the company. So You might have heard that companies' sizes are referred to as market capitalization. This is one of the most popular combination of words in the stock market, basically. Market capitalization this, market capitalization of that. We heard market capitalization of Tesla exceeded market capitalization of BMW, Mercedes, Toyota combined. So what is exactly market capitalization? Market capitalization, or it's basically the size of the company. This is the number of shares outstanding multiplied by share price. That's it, simple as that. This is the way you estimate how big is the company. So for example, first of all, shares outstanding, it means shares on the market. Because company have, for example, company issued 1 million shares, but there's only 800,000 shares on the market. And those 800,000 shares are shares outstanding. But the rest, 200,000 shares, these are treasury stock. These are the shares that are still inside the company, that are not traded on the market. So market capitalization, first of all, this is the number of shares outstanding multiplied by current share price. And once again, if we have, let's say, so 800,000 shares outstanding, okay, and the share price of each share is $20. So the market capitalization of this company is 20 multiplied by $800,000, which is 16 million. So market capitalization of this company XYZ is $16 million. Simple as that. And companies are divided into 3 categories. Small cap, small capitalization. Cap is just short for capitalization, obviously. So small cap is from 300 million all the way to $2 billion. Medium cap is from 2 billion all the way to $10 billion. And large cap is everything than 10 billions and above. So basically as simple as that. And generally, the bigger the company, the less volatile it is. It is obviously not always the case, but generally speaking, once again, the bigger the company, the less volatile it is. Because imagine like Coca-Cola, massive giant. What will it take for this company to have its share price going up and down like crazy? Like it is very hard for such giants to be extremely volatile. It is extremely hard for these giants to make their revenues increasing like 30% every single year. I know, let's say, so imagine your revenue is a small company, your revenue is $100,000. It is way easier to make 30% revenue increase for the next period and make it from $100,000 to $130,000 because you're still small. But whenever you're a giant and let's say so your revenue is $100 million, it is extremely hard to increase it by the same 30%. It is extremely hard to make extra $30 million in revenue. That's why, generally speaking, the bigger the company, the less volatile it is, which basically means as an investor, if you want to have less risky companies, if you want less volatile companies, if you're afraid of prices going up and down like crazy, it is probably a better idea to invest in bigger companies. Okay, questions and if any people joined. I don't see any people joined. I don't see any questions if I'm not mistaken, which basically means we can continue. Okay, the next important factor to take a look at, to take into consideration while analyzing a company are the plans of a company and the condition of the company, current condition of the company. Obviously, the company must have clear future goals and plans. And all these things you can extract either from the website or like from shareholder meetings or from any publications, press releases, or also you can extract this information from the prospectus of the company. And prospectus is the document as soon as the company goes public, they need to provide prospectus. And this is the document that they're giving to SEC. And prospectus basically says what's the company about, what its goal, what's future mission, what is plans for the future and all this kind of stuff. Like who is the top management of the company. Like it's like summary of the company basically. So a company must have clear future goals and plans. It cannot just produce one product, provide one service, and that's it. Because like if the company is just doing one thing, I don't know, for example, I don't know, like tires for the cars, okay? So if the tires of the cars are not even being developed, like if the tires of the company are not being like modified, if this is the same tire, like the same tire, Obviously, as soon as competitors will enter the market, they will be improving, they will be making better tires, they will be making tires which have better grip with the road, they'll be making better winter tires, better summer tires. So eventually, competitors will surpass companies that do not develop, that do not have any future plans or goals, that do companies that just do not develop anything. So it is basically self-explanatory. It's common sense that you want to see a company that has clear future goals and plans. And also one of the example that always you need to try to produce something new, like I already said, otherwise you'll be overtaken by competitors. Also, one of the best examples is car manufacturers like BMW, Mercedes, Toyota. You see every single year there's a new, like if you're talking about BMW, if you're talking about Mercedes, for example, okay? Every single year there's new C-Class, new E-Class, new S-Class, new A-Class, new B-Class, because they're always producing new and new and new cars, because if they don't do it, and BMW will be doing new 3-Class, new 5-Class, new Class 4, so Mercedes basically will be it will be aging way too fast, but that's it. BMW will win this car race against them. So you always need to produce and develop something new. And value investing is investing in marathoners, not sprinters. This is related to the condition of the company. Once again, you want to invest in the company which provides more or less stable revenue growth, which is growing stably, which means this. If the company is growing like it's already established, the big company with the good financials, and let's say so it's growing around 10% per year, this level of growth is more or less manageable to maintain every single year, because the market grows approximately 10% per year. So it is achievable for a company to grow at this rate. Obviously, the bigger the company, the harder it is to maintain such levels of growth. But for example, imagine medium company, which grows like 30% per year. So right now it's going to be exponential growth. Right now it's worth, let's say, so $1 million of revenue. Next time it's $1,300,000, and like 10 years from now, it's going to be like tens of millions of dollars, let's say so, okay? If not more than this. So at this time, the same 30%, like I mentioned in the beginning, it will be already basically instead of $300,000, it will be already $3 million that they need to achieve. So it is very extremely hard to maintain very high growth rates. Obviously, it is very tempting to invest in a company which grows like 30%, this year 50%, this year 70%, next year very tempting. You see that the company is exploding. But this rate of growth is extremely hard to maintain, extremely hard to maintain. And those companies are usually overvalued, and investors are very speculative about this company, which basically means they already know that their investment is growing like 30% per month, 70% per year. So they know that the investments are growing way too quick. And as soon as the company does not meet its expectations, they will start selling their shares to lock the profits, to basically take the profits. For this reason, those high growth companies, yes, they might be growing very quick, but as soon as they have something bad, or as soon as they don't meet expectations, the fall is going to be like pretty sharp. So if you're a value long-term investor, as tempting as it can be to invest in growth companies, it is better to at least limit the amount of growth companies in your portfolio. You may have 1, 2 of them, but if you're having like 10, 15 of them, it is like very tricky. You need to pay very, very close attention, and you become already not value investor, you become growth investor. And strategies between these two types of investors are pretty different. Okay, let's see questions, and if there are any people joined. No questions, no people as far as I see, we can continue, we shall continue. Next thing to look at is the management of the company. And the first thing you want to look into is if the top management of the company has similar prior experience. And the best example, which is the worst example, is Nikola. I don't know if I'm making a couple of videos on YouTube about Nikola, or maybe you heard about Nikola. Like basically this is the company that's like fraudulent scam company that's producing this hydrogen fuel cell like trucks that not even moving, that they're using gravitation to roll, like scam, basically scam. And so the guy, he is doing typical, like, I don't know, pump and dump. He is like, our trucks are the future. We will beat Tesla, this and this and that. So pump and dump Pump and dump means that you do not have quality product or quality service, but you make it you advertise it so much, you market it so much, you say it like it's the future, you say it everywhere, you're very persuasive, you're making the best presentations ever. So people believe it, they start buying your shares, and like I said, your company doesn't even have quality products yet. And then basically, as soon as the share price is high, you sell all your shares, you escape, you sell the company, and that's it. Like, you're a scammer of 21st century, long story short. This is what's happening with Nikola right now. And it is very important to see that top management, like I said in the beginning, has similar prior experience, because chief engineer or something like this was the guy who was, I don't know, repairing paintball machines. Chief logistics officer, he was the previous manager of the golf club. Or another guy, Trevor Milton's brother, is chief of infrastructure development, something like this, director of infrastructure development. Previously, he was pouring concrete. He was like just basically worker. He was construction site worker. And now he's the director of infrastructure development. This is absolutely unrelatable. This is the guy who maybe doesn't even have any degrees, university degrees, who might, I don't know, he's finishing school or not. But this guy was literally a construction site worker, and now he's director of infrastructure development. Completely unrelatable. Tesla was just way too obvious that this company is a scam. And if person who was analyzing the company, he will see it, like there is no way for the smart person who has like common sense, there is no way to invest in this company. So first thing to look at, and the most important thing to look at in the management category of the company, and is if the company, if the management, especially top management, has similar prior experience. And those things you can find on Yahoo Finance or LinkedIn. So basically you go to Yahoo Finance, you put the company's name, you see the top management people names, or you just Google like who's the CEO of Nikola, who's the CFO of Nikola. And then you go to LinkedIn, and usually those people, they have their like resumes attached or their previous experience attached in LinkedIn or somewhere else. Basically, it's not the hardest thing to find if the person has previous prior experience, and basically to see if it's similar or not. Also, salaries of top management must not be extremely high. If you see a top management, and I'm talking about salaries, I'm not talking about net worth, because this is a very common misconception. For example, you can see that, I don't know, like CEO of one company, I don't know, Jeff Bezos, okay, $200 billion, but majority of his wealth is because of the stock, Amazon stock. It's not that he has $200 billion in cash in his bank account. No, he does not have it. He maybe only have a couple of billion of dollars in his cash account. I have no idea how much, but the rest is because he has Amazon shares, and now Amazon shares are like what, 3,500. Majority of his wealth is because he owns stocks of Amazon, not because, so like I said, he does not have 200 billions on his checking account. No, he does not have. And what I'm talking about, that you need to look at the salaries, not net worth of these top executives. So net worth of top executives can be as high as you want, doesn't matter. But if you see that the salary is like, I don't know, 50 million per year, 100 million per year, this is a bad sign. It means that basically company operates, company works, company makes money just to pay salaries of these executives, like literally. Everything that the company makes, majority of this goes to salaries, to top management. Obviously, it's not good. There are way better things you can do with cash, with the revenues, with the money the company makes, other than just paying salaries to top executives. And the last thing is basically personal attitude towards management. I don't know, if you want, you can follow closely the guy, I don't know, CEO of Tesla, Elon Musk. Everyone likes the guy. He's pretty funny, meme lord. I don't know, he's making funny statements. He's doing funny tweets and stuff like that. He's just nice guy. And this is sometimes it is enough for you to, it's not supposed to be your only criteria to invest in a company. Okay, I just like Elon Musk, I will invest in Tesla. It's never supposed to be your only criteria, but it can be one of the decision-making points. Just basically, if you like the guy, if you see that the guy is humble, if the guy is decent, if the guy is smart, if the guy has good like relationship with the public, if you see that the guy is decent and humble, or the woman is decent and humble, like that's it. Yes, it's a plus sign. it's the good thing for the company to have humble and decent and trustworthy top management, basically. Okay. Questions, participants, no one joined, no questions, so I guess I can continue. Going good today. Okay, so next thing is insider trading. So insiders are usually employees of the company, especially top management of the company, once again, CEOs, CFOs, and you can see if they're buying or selling their own shares. This information is supposed to be public because the company is public company, and if there are any big money movements inside the company needs to report this. And as you can see in the point 3 here, Form 4 is the most common form to track insider trading. So basically you can go to the SEC website, Edgar database, and just select a company and filter it by Form 4. And Form 4, it shows basically the share ownage, I don't remember exactly, share ownership changes, let's say so. So, which basically means if insider, let's say so, CEO of the company decides to sell 100,000 shares of his own company, he needs to report it and file Form 4. And the same thing, if he wants to buy 100,000 shares of his own company, he needs to file Form 4 and report this. So basically it shows that it shows the following thing. If insiders buy their own shares, mostly it's good because they are insiders. They know the company better than anyone else, basically. They're responsible for making company better, for making company more profitable. So if you see that the top management has faith in its own company, it's always a good sign. Like it's mostly a good sign, I mean, yes. So, or for example, another reason why insiders can buy their shares if they think that the share price is undervalued. So they'll just buy the share and then they'll just keep working to make the company be more valuable and increase the value of their shares. But if you see that the insiders are selling their own shares, especially top management, CEO, CFO, usually it's not good. Usually it means that something bad is coming. And they cannot, by the way, they cannot be doing like typical insider trading. They are restricted from trading on their insider knowledge. So for example, if they know that the company is going to do mergers and acquisitions, let's say so, and they know that the share price will go up, they cannot buy shares like one day before the merger and acquisition. This is illegal. But these type of trades, whenever they sell 100,000, buy 100,000 of shares, these are type of insider trading that happens without any major events happening in the nearest future. So this is literally when the guy just basically mostly buys shares, just like he's sitting like in his office, and then he's like, okay, I think my company shares is undervalued, I'll just buy them. So basically it's very tricky to see the difference between illegal insider trading and legal insider trading. But still, if you see that insiders buy their own shares, usually it's good. And if you see that insiders sell their own shares, once again, usually it can be either that something bad is coming, maybe in the future. And once again, it's very tricky to have the difference between illegal and legal. Or, for example, if the management of the company thinks that the shares of the company are overvalued. So that's it. He just wants to lock the profit. He sells like 0.005% of his shares, which is like, I don't know, 20,000 shares. He locks, I don't know, like a couple of like hundreds of $1,000s, and that's it. This is his like bonus, basically. So those things are healthy and natural. But since we're all hopefully value long-term investors, we do not need to care that much about insider trading, because all this insider trading, it's trading related. All these things, they affect daily stock prices, weekly stock prices, maybe even monthly stock prices, but no more than this. All those things, all those price movements are just temporary. It's not decreasing or increasing the value of the company if the guy just sold 10,000 of its own shares. No, the company might still be productive, might still be profitable, might still be outputting a lot of revenue, basically generating a lot of revenue. So those things are usually for traders, but this is one of the things that it's just good to know, basically. Okay, let's see questions or if people are joining. No questions as far as I see, and I don't see that people are joining, so I guess good to continue. Full screen. Okay, next thing to look at are the mergers and acquisitions. And usually you would see those things in one sentence, mergers and acquisitions, or M&A. But these are two different things basically. Merger is when two companies combine its businesses and operate as one. So for example, I don't know, just very, very theoretical example, okay? What can I do? I don't know. Notebooks, okay, laptops, I mean, yes, Samsung, I don't know, Samsung, for example. Samsung merged with Toshiba or Sony. Samsung is merging with Sony. And most likely the new company will be called like Samsung Sony or Sony Samsung. So merger is when two companies, they combine their businesses and operate as one, but those companies, they still like exist basically. It's not that one company completely absorbs another one. There are still two companies, they just work together basically. They're working as one, but still these are two companies. And sometimes they keep their names. And once again, they use like Samsung / Sony, Sony / Samsung, something like this. Or maybe they can just keep one of the names. So it's healthy basically. An acquisition is when one company, usually bigger company, way bigger company, buys another company completely, and usually it's smaller company. And this is, for example, you know, like Pepsi Cola or like Volkswagen. I mean, yes, Volkswagen is better for me. I know more about this. Volkswagen is the company, but they own Porsche, they own Bugatti, they own, I forgot something else basically. So this is acquisition. Like there is still, yes, Bugatti and like all this stuff, but Volkswagen acquired them. So it took them, basically it bought the company completely, but because it's car industry, because people want to buy Bugatti, because it's called Bugatti, they don't want to buy Bugatti, and it is Bugatti, but it's called Volkswagen. So like they just acquired Bugatti, but they kept their name because name is also a part of the goodwill. Name is already like basically Bugatti. Whenever Volkswagen buys Bugatti, majority of the price that they're paying for the acquisition is for its brand name. So they're buying the brand plus all of its assets, such as like factories, equipment, personnel, people. So they might replace those some people. So whenever acquisitions happen, sometimes a bigger company fires majority or maybe all of the old company's personnel and recruits new people basically, yes? Or sometimes they keep them. So this is what happened, for example, when Volkswagen bought Bugatti. They retained, they kept the Bugatti because Bugatti as a name, as a brand, already has very big and very good history. And lastly, if there is more than 3 acquisitions per year for a company, it's bad because like acquisitions cost money, obviously. Like in order to acquire a company, you need to buy majority of its shares. Like you need to buy 51% plus of the shares of the company in order to own it. And obviously it costs money, like I said. So if the company is doing just acquisitions every single year, doing 5, 10, 15 acquisitions, it means that the company does not know what to do with its own money. And usually there are a lot of things that you can do with the money: research and development, expansions, like entering new markets, like expanding to different countries. There's so many things you can do with the money, and acquisitions are usually just, it's not the worst thing to do, but if it's a lot of acquisitions, it means that the company just diversifies, buys more and more companies, all the way until there's so many companies, it's so hard to keep track of them. And just, yes, you own like hundreds of companies, but like it's a chaos basically. So it is generally, it's like not 100% that if you have more than 3 acquisitions per year, it's bad. But generally speaking, according to this book, Intelligent Investor by Benjamin Graham, our father of investing, he says that it's good not to have for a company more than 3 acquisitions per year. And still 3 acquisitions per year, it's pretty big amount. It's pretty big number, I mean, yes. So sometimes companies do not acquire anything like for any single year, like 1 acquisition per year. So anything 3 or below, maybe it's healthy acquisitions. Everything above could be harmful. Okay, let's see, participants, no participants, no chat. So we continue, and I have 7 minutes left, and just two more, just one last one, and then questions. So this is the last slide. After this, there will be questions. So if you have any questions, get ready with them. Like I said, I have like 7 minutes left. So let's do it. And the last thing to look at is customers and other factors. Customers of the company. The company must not have one or very, very few dominant customers. Okay. So imagine if the company has one customer, which is responsible for 50% of the revenue. Imagine this customer finds someone better with better prices, and this customer leaves this company. That's it. Company loses 50% of its revenue. There must not be dominant customers. Companies must have very big pool of customers. First thing, once again, if they lose this customer, they will lose majority of their revenue. And the second thing, if the customer knows that he is responsible for 50% of the revenue of the company, this customer has very big leverage. This customer can influence the prices, like blackmail, if you want to call it like this. For example, imagine you know that you are responsible for 50% of the revenue of one company. And then you say, give me 20% discount or I'm leaving. And this company has nothing else to do because they don't want to lose 50% of the revenue. They're ready to lose, okay, 10% of revenue, but losing 50% of revenue is much worse than losing 10. And that's it. And these such customers, they have very, very big leverage. They can influence basically anything. They can control you basically, whatever they want. They can control your prices, they can control infrastructure, they can affect anything you do. And this is basically just one of the things about customers, the one and only thing that good or bad about having customers. And other factors such as good competitive advantage. It's good to have, for a company to have good competitive advantage. For example, Coca-Cola recipe. Yes, there are multiple options for sodas, but Coca-Cola is Coca-Cola. Its recipe is hidden, no one knows it technically. It is Coca-Cola, very good competitive advantage. There are other sodas, but there is not a single one like Coca-Cola, of course, maybe except Pepsi, but still they kind of taste different. Other factor is research and development spendings. And this is also what I found in the Intelligent Investor book. It is good that if the company is spending around 11% of its net sales towards research and development. Obviously, if the company is like utilities, like consumer staples, this number is going to be closer to 4%. But if this is like technological company, it's going to be closer. It's good to have it closer to 11%. Companies need to develop, need to research stuff, need to advance, need to be better and bigger. And this is why spending money on research and development instead of multiple acquisitions per year is much better. And last factor, that if a successful company overcomes difficulties, usually they come out even stronger. Obviously, this is not 100% confirmed, but this is kind of, once again, generally speaking. For example, if the company was previously successful, but then it faced difficulties, so it lost a lot of shareholders, a lot of investors, but then it overcame difficulties, survived, and now it becomes how it's called, successful again. For example, Apple. Everyone like wants to invest in Apple, let's say, so, but some people think that, okay, the price is way too overpriced, it's way too overvalued. And then Apple faced difficulties. Price fell like 80%. And then people like, okay, I'm not going to invest in Apple, it's a bad company. But then you see that Apple starts recovering and starts being good a company again. And people like, okay, like Apple is a pretty good company and now it's trading with like 80% discount, I will invest in it. And so successful companies which experience difficulties, and if they overcome these difficulties, usually, generally speaking, they tend to come out even stronger. And basically that's it. If you have any questions, we have 3 minutes. If you have any quick questions, let's see. Okay, I opened the chat, open the participants. Thank you all for staying all the way until the end. So that's it for today. So if you have any questions, now's the time. I will end. Finally, I made it in time. So yes, if you want to type something, or if you want to use microphone, feel free. Thanks so much for joining, Travis. You learned hopefully a lot of good stuff, and this is how it is every single week. You know it. You participate in every single meeting. Thank you so much for this. Like, very good. Okay, so Adrian asks, which are some of the most suspicious companies you've seen so far? Nikola is one of the most suspicious company I've seen so far. and it's like literally the most, like, this company does not even try to hide its fraudulent activities. Like I said, the company in the second quarter of 2020 made $36,000 in revenues, and we are speaking about multi-billion-dollar company which made $36,000 in revenue. And the only source of revenue was that Trevor Milton, who is the founder of the company, he installed solar panels in his house, and that's it. This is the only revenue that the company, which is producing hydrogen fuel cell trucks and vehicles, this is the only revenue that they made, solar panels installation for the CEO. Ridiculous. So they're not even trying to hide those things. Everything is very scammy, suspicious, very bad. Top management doesn't have prior similar experience. Like, it's a mess. So this is one of the most ridiculously bad companies I've seen so far. And I am doing my YouTube videos about it. I think I have like 2 or 3 already. So yeah, this is the company. Yes, this is recorded webinar, will be recorded. It is recorded, basically. It is recording right now. I will put it on YouTube. We'll share a link with you all later. It usually takes maybe 30 minutes, 1 hour maybe to add on YouTube, write timestamps, to create thumbnails and all this kind of stuff. We'll share it with you. And you'll see, okay, Adrian asks, your favorite CEO. In terms of personality, Elon Musk is a cool guy. I know I don't like investing in Tesla. I don't like Tesla as an investment, but I like Tesla as a company. And I've already been saying this multiple times. He's pretty cool guy, meme lord, smokes weed, smokes joints, like being, I don't know, cringe sometimes. So he's just a cool guy. Like Jeff Bezos is also a cool guy, like this brain maniac, like $200 billion is just insane. Basically, I guess these are the first ones that came into my mind. So far, that's it. Less than a minute left in the meeting. Guess it's good time to say goodbye. Thank you all so much for joining. Thank you so much, Adrian. Thank you so much, Julian. Thank you so much, Travis. See you next week. Bye.